For younger long-term investors, getting started early in the stock market can give you a huge upper hand against those starting a little bit later on in life. Now, this is partially because the power of compounding is an important factor when it comes to investing over a long time period. And this is because as the initial investment pays dividends and they are hopefully reinvested, along with more and more small or large additional capital added to the portfolio over time, the snowball effect really starts to take place and the portfolio almost seems to have a life of its own. Now in this video, we're going to go over two different high quality dividend growth ETFs that are perfect for investors to buy if they are still relatively young and looking to grow a massive dividend growth portfolio long term. Now stick around because we're going to go over all this and more. Right after you, please drop a like on this video and subscribe for more future content like this. Now quickly, before we dig into these two awesome ETFs, let's lay down some of the groundwork and figure out exactly what makes a perfect dividend growth ETF for a younger long-term investor. Now, some of the main things that these ETFs are going to need to cross off are things like a long track record of historical performance. Now, this is not necessarily only dividends, but also how has the ETF traded over time? Has it decayed in price a bit, or has it been trading up and to the right historically? These ETFs are also going to need to have a nice, decent starting dividend yield, something in the 2 to 4% range. And although if you're under 30 years old and you're looking to invest long term and not touch the portfolios, just let it do its thing, a nice starting dividend yield doesn't really matter all that much. But for those like myself that are looking to retire a little bit early, a nice starting dividend yield will definitely have some higher cash flow coming in from day one. Now also, these ETFs are going to need to have strong dividend growth, and both of the ETFs that we're going to go over in this video definitely have that. They're also going to need to have a diversified basket of stocks within the ETF that can hopefully perform pretty decent in almost any market conditions. So now that we know exactly what we're looking for, let's dig into the first ETF that I think is perfect for a long-term investor under 30 that's looking to build a massive snowball of wealth. Now the ETF that I'm talking about is none other than SEHD. So let's quickly back up for a second. If you don't already know, SEHD is an acronym for the Schwab US Dividend Equity ETF, which is an exchange-traded fund that invests in high-quality dividend-paying U.S. stocks. The fund is managed by Charles Schwab Investment Management Group and seeks to track the performance of the Dow Jones U.S. Dividend 100 Index. Now, the Dow Jones U.S. Dividend 100 Index is a subset of the Dow Jones U.S. Total Stock Market Index, which includes the top 100 U.S. companies with a strong track record of consistent dividend payments, and on top of that, also a history of increasing their dividends over time, which is my personal favorite part of these names. The SEHD ETF invests in these companies, which are spread across various sectors of the economy, including healthcare, consumer goods, technology, and financials. Now, the first reason why I think SEHD is a superior investment to pretty much any single stock or any other dividend ETFs is because of the starting dividend yield. SEHD gives dividend investors a good starting dividend yield, which can allow the dividend investors to expect nice sized dividends pretty much from the start. And in general, when it comes to dividend growth investing, which is invested into dividend paying stocks that have a potential to grow in the future, it's really tough to find other ETFs and single stocks that have the same quality as SEHD and that also start with a well above 3% starting dividend yield. Now, some really important facts when it comes to this investment vehicle, SEHD, the fund's inception date was October 20th, 2011. So this ETF has been around for a while, and why I find that important is because we have a decent amount of track record to go off of, and even though past performance does not guarantee future performance, it's still nice to have some data to go off. Now, SEHD is one of the largest ETFs across the market at almost $49 billion of total net assets. The expense ratio is very cheap at just 0.06%, making it one of the cheapest ETFs to hold long term, which is definitely important, especially as investors get more and more invested as time goes on. SEHD is currently trading at $74.35, and in my opinion, for a long-term investor, at least for myself, I still think SEHD is at a decent price right now, and I've been buying shares almost every single day as of recently. SEHD, as far as performance, is up 185% plus since the inception of the ETF, and that's not including dividends. The 52-week range is 65.96 as the low and 79.49 as the high. SEHD has an expense ratio of just 0.06%, so it's very cheap to hold long term, pays a dividend quarterly, and has a starting dividend yield of around 3.48%. The next dividend growth ETF that I think is perfect for a younger, long-term investor to hold on to until retirement is none other than VYM, or the Vanguard High Dividend Yield Index. So VYM, or Vanguard High Dividend Yield ETF, is an exchange-traded fund launched and managed by the Vanguard Group. This ETF invests in public equity markets of the United States. The fund invests in stocks of companies operating across diversified sectors. The fund invests in growth and value stocks of companies across diversified market capitalization. The ETF invests in dividend-paying stocks of companies. And the fund seeks to track the performance of the FTSE High Dividend Yield Index. Now, VYM is a well-diversified portfolio, with 19.18% being financials, 15.05% being consumer defensive, healthcare being 14%, industrials at 11%, energy at almost 11%, technology at 8.5%, utilities at 7%, consumer cyclical at 6.9%, communication at 3.8%, base material at 2%, and a tiny bit of real estate. Now, VYM is made up of 469 different companies, which means obviously the fund is very well diversified. So for the investors out there that want a small piece of a lot of different high-quality dividend-paying companies, VYM could be a good option. VYM's top 10 holdings are very familiar. We have ExxonMobil at the top, we have Johnson & Johnson, JP Morgan, Procter & Gamble, Chevron, the Home Depot, Merck, abbvie, Pepsi, and Coca-Cola. Now, these top 10 holdings have a long-standing history of decent performance overall, and of course a history of paying dividends consistently and raising them over time. Now, VYM, just like SCHD, has performed pretty good, up over 114% since inception, and again, that is not including dividends. VYM's trading at the higher end of the 52-week range at 108.72, with 94.59 being at the low and 113.78 being at the high. VYM has the same exact expense ratio as SCHD at 0.06%, also pays a quarterly dividend, has a nice starting dividend yield of 3.06%. And just a side note here, since SCHD and VYM both have a starting dividend yield of over 3%, that's definitely going to give investors a decent amount of cash flow pretty much from the start. So there we have it. Those are two, in my opinion, very high quality dividend growth ETFs that are perfect, or at least very close to perfect, for long-term dividend growth investors that want to build a massive snowball of wealth by the time they reach retirement age. And the cool thing is that there's so many high quality dividend growth ETFs out there, and of course by no means are these the only two to choose from. But that being said, out of all the options out there, VYM and SCHD are definitely two of my favorites. But I want to hear from you guys down below when it comes to a long-term hold for a dividend growth ETF that you personally think would be great for a younger investor. Comment down below some tickers that you think we should look into. If you enjoyed this video, make sure to please drop a like down below and subscribe for more future content like this. Thanks for stopping by, guys, and I'll see you in the next one.